On this episode of Retiring Today, we'll talk about the market and your portfolio.
And we'll show you how to make it so your investment emotions don't have to be nearly as volatile as this crazy stock market.
Join us for Retiring Today. Welcome to Retiring Today with Lauren Merkle. In this episode, we're talking about your portfolio and the market and how to avoid a meltdown. I'm here with Lauren Merkle. He's a certified financial planner. And Lauren, you like to, in this show, talk to the people in the audience about what you talk to families about every single day. And we were just discussing how 2018, for some of the families that you work with, was kind of a volatile year when they were looking at their portfolios.
2018 was a volatile year for anybody with money in the market. And it is a wake-up call because really since the last recession, there hasn't been a lot of volatility like what we saw in 2018. But what we saw in 2018, if we look back historically, it's not actually an anomaly. It is more of the norm. And what helps get pre-retirees, what helps get retirees through challenging years in the market like a 2018 is a good, well-written retirement plan that clearly explains, even if we have a little bit of volatility that we don't like, that we're still going to be okay. We're still going to be on track to accomplish what our goals are throughout the course of your retirement.
And that's the goal of the show today, is to talk about how to avoid anxiety or have peace of mind in retirement. And sometimes you have to take a little bit of a look back to see that this isn't that anomaly that you discussed. So take us back a few years and show us what the market's done.
Yeah, what we're looking at on the screen is just a glimpse over the last 5 years of the S&P 500. And if you look at this line, you can see it's pretty, I mean, there's a little volatility throughout 2015, but it really doesn't start to hit until late 15, early 2016. That's what those lines are demonstrating there. And then it's pretty much a straight uphill climb through all the way up till 2018. The volatility then crept back into the market 2018, where we saw two corrections throughout the course of 18. If we remember back to February of 2018, the S&P 500 was down more than 10%. And then certainly, how can we forget fourth quarter of 2018, where in December alone, the S&P 500 was down over 9%. So 2018 was a little bit challenging. The historical norms are much more like 2018, which is what we're showing on this next graph. And what this next graph shows, again, the S&P 500, but the red lines indicate the number of days throughout the course of that year that the S&P 500 moved by more than 1%. The blue lines are more than 2%. So if we look at 2018, compared to maybe like a 2008, even a 2009 or a 2001, 2000, I mean, it was significantly less movement than what we saw even over the last 20 years in the marketplace. So again, 2018 felt a little bit more volatile, but if we look at history, it really wasn't as volatile as what we have seen historically, certainly over the last 20 years.
Okay, so families call in that maybe didn't set their plan up with you, or people are watching thinking, yeah, I didn't like what 2018 did to my portfolio. They call, what's the next step when they call and say that concern to you? Well,
there's probably nothing more emotional outside of the health issues that could take place than seeing your portfolio evaporate. You know, you spent 30 years building this portfolio up to a place where you feel like you're in a comfortable position to retire and do all the things that you've always dreamed of doing. And then you go through a period like maybe an 18 or certainly like a 2008 where you saw your portfolio just evaporate, and this feeling of helplessness where you just feel like there's nothing you can really do about it except for watch and pray that it's not going to get any worse. And one of the messages of what we try to convey on the show or the classes that we teach is that's not necessarily the case. You have more control than what you believe. Certainly, we do not have control over what the market does. Right? We can't control what the S&P does. We can't control what the Dow does. But to some degree, you can control how your portfolio reacts to the market. When the market dives by 40%, your portfolio does not have to lose 40% of its value. In 2008, people lost 50% plus of their life savings in a relatively short period of time. That doesn't have to take place. It's all about the construction of your portfolio, putting it in a position where you can not react like the market, but yet you can still achieve your retirement goals.
Okay, so in front of us is what might resemble a Jenga game here. We've got some color-coded tape, and it's a visual to represent how to maybe work to give you some peace of mind in your portfolio?
Yeah, everybody wants, most retirees, that's what they're looking for. They're looking for the peace of mind or the sleep insurance where you can go to bed at night, you can put your head on the pillow and you don't have to wake up at midnight or 1 o'clock and think about, I wonder what the market is doing the next day that's going to derail my retirement. One of the ways, just an easy visual to help explain to the audience to say, this is what, from a broad perspective, this is what a well-diversified portfolio might look like. And it's important to understand when we're talking about diversification in a portfolio, what we need is products or investments that are different than just stocks and bonds. The old 60% stocks, 40% bonds doesn't work like it used to in the 90s. And we saw that in 2008. In 2008, if you had a traditional 60-40 split, your portfolio was still down probably over 20%. And that's not what pre-retirees and retirees want to achieve their goals. So in this visual, what this yellow segment looks like right here, this is the foundation of your portfolio. If we think about building a house, all well-built houses are built on the foundation. And that foundation has to be solid. If that foundation is not solid, what happens to the house?
Over.
Right, it falls over. That's not what you want to have happen to your portfolio. So this piece here is the foundation, and it's guaranteed, which means regardless of what happens to this market, it's guaranteed you cannot lose any money, which is the challenge in today's environment because where are interest rates?
Low.
Right?
Yeah.
Which means that guaranteed investments, many of them are not supplying the interest or the return that is necessary to generate the target return of your portfolio. So we have to get creative in here, and there's a lot of options. But the idea here is this is foundation, it's guaranteed, can't lose, regardless what the market does. As we build up, now the risk level increases. And to what degree is vastly dependent upon what it is you are trying to accomplish from a portfolio or retirement standpoint, and how much risk you feel comfortable with. Because Molly, the risk that you feel comfortable with in your retirement plan is probably significantly different than somebody I will meet with later on in the week, right? Everybody has a little bit different appetite and necessity for risk. And then up here, we increase the risk a little bit more. And this is where we kind of sprinkle on a little bit of extra risk to try to obtain these longer term goals. But you'll notice, look at the size of the foundation as compared to the elevated risk, and then even the more elevated risk. It gradually gets a little bit smaller, which is pretty traditional of a retirement constructed or retirement constructed portfolio.
Okay, we're talking about a peace of mind in your portfolio. Next up on Retiring Today, we bring in investment advisor Abby Huntrods. She'll talk about the emotional response to investing.
You have worked for a long time. There are so many decisions to make about your retirement. How much income do you need? How not to run out of money? Now is your chance, and you get one shot to get it right. Attend Merkle Retirement Planning's Passport to Retirement. We will discuss how to create tax-free income, how to avoid the next market meltdown, and how to wring every dime out of Social Security. Your time is now. Classes fill quickly. Call or text today. Zero cost to attend. You made it. Years of hard work, investing, planning, and now you are here. The long-awaited reward you spent a lifetime looking forward to. But what now? After years of growing a nest egg, now you may want to manage it. Use it to fund your dreams. Make it last as long as you need it, and leave some for those you love. So what do? Wall Street continues to be uncertain, and some conservative options have dropped through the floor. How do you maintain opportunities for growth and reduce risk of loss from market changes? That's where we come in. We are Merkle Retirement Planning, your personal retirement planners. From investments to tax reduction strategies and creating your blueprint to retirement guide. Have the confidence to retire today. You worked a lifetime to get here. Let us help you enjoy it to the fullest. For a complimentary visit, contact us today. Merkle Retirement Planning.
Welcome back to Retiring Today. In this episode, we're talking about your retirement portfolio and the market. I'm here with Abby Huntrods and Lauren Merkle. Lauren is a certified financial planner and Abby is an investment advisor. And Abby, we went back to 2018 in the first segment, and especially in December, you took a lot of phone calls here in your office when the market went down. And what happens with investing in portfolios is that people get their emotions as part of when they see that go down, they get emotional about it. That's expected, but there are definitely some things that can be done to sort of mitigate that anxiety.
Yeah, absolutely. Remembering your time horizon is important for starters. So if you have a well-designed portfolio that has some different components built in risk-wise, then it's designed to weather that short-term volatility that we didn't see a lot of in 2017. So then it's a little bit more painful when it returns in like it did in 2018. Also, it's important to try not to market time. So we have a lot of people who want to go to cash in those situations. And there's a lot of interesting information on if you miss some of the best trading days in the market, how that impacts your portfolio. The graph that you're looking at on your screen now, if you would have invested $10,000 in 1980 and left it invested, through May of 2017, it would have grown to $615,000. But if you miss just five of the best trading days through that whole almost 40-year time horizon, you would have lost out on over $200,000 in growth. So that's a pretty strong indicator that the windows of opportunity to make money in the market are very small. So you have to really be willing to ride it out a little bit. Again, it's important to have a well-designed portfolio that has the diversification needed to weather that kind of volatility.
And Lauren, those emotions probably can't be avoided, but you can definitely, again, put some things in place to kind of help ease them.
Yeah, I think mitigation. Avoidance isn't necessarily possible for a lot of retirees because, it's their life savings. You spend 30, 40 years accumulating this money, so you're invested completely. But we can mitigate that emotion by having that plan put in place and being very specific and detailed about, because one of the things that offers this emotionality is they're dependent upon this portfolio. If this portfolio drops in half, now their income's going to drop, or maybe they have to come out of retirement. So it's not necessarily the market movements that is creating this emotionality. It's what they're envisioning their retirement, the rest of their retirement looking like. And the plan can really mitigate that by having a well-written plan saying, here's where my income's going to come from right now. Regardless of what happens in the market, you're going to be able to get that income. Here's where the income's going to come from 5 years down the road, 10 years down. Regardless of what happens in the market, you will be able to get this income. So not having a market-dependent plan is vital to controlling the emotions as we go through these ups and downs, which inevitably is going to continue to happen throughout the rest of your retirement. So
if there is some volatility in the market, yes, we understand sometimes people want to go to cash, maybe even put the money under the mattress, but really that's not the smart financial decision to make.
No, absolutely not. So it is tempting to go to cash-like investments, but at the end of the day, those types of investments ultimately just decline in purchasing power because inflation eats away at what you can do with those types of investments over time. So really corrections can be an opportunity to take advantage of. So if the market is down, how do you make money in the stock market, Molly?
Buying when it's low.
yeah, you got it.
So pay attention.
You have to buy low and sell high, but you can't do that if you don't position yourself in a way to take advantage of a market recession or a correction. So if your portfolio reacts like the market reacts, you're not going to be positioned in a way that you can take advantage of those buying opportunities.
That's an important takeaway, because most pre-retirees do not want their portfolio to act like the market does. Because what that means is when the market loses 40%, your portfolio is going to lose 40% plus. Mm-hmm. So it's really important, and we spend a lot of time talking with our families. At the Passport class, we spend some time talking about making sure that the amount of risk you're taking in your portfolio is commensurate with what you're comfortable with. And again, most pre-retirees, retirees don't want all of the risk of the market. So you first need to figure out, how much risk are you taking in your portfolio? How much risk are you taking doesn't match up with what you need to take to accomplish your goals from an income standpoint and longevity standpoint, and doesn't match up with what you feel comfortable with. Those three things are really important, and we provide as a part of our assessment after the class, the risk assessment, to show you how much risk are you taking. When this next recession does happen, how much would we anticipate, based on the way your portfolio is constructed, how much would we anticipate you losing over the next 12-month period of time? So figuring out how much risk you're taking, does it match up with what you feel comfortable with, is absolutely essential.
Well, and I think too, because we've had the market, we talked about 2018, the market went down, but overall in the last several months, the market has gone up and up and up. And I think probably some retirees are like, it's done so well for me. The market has done so well. They're tempted to come out of it because it's done so well.
Yeah, that's certainly a point. I mean, really, since beginning of 2009, the market has gone like this, except for there have been some small hiccups along the way. The most recent is 2018, which also adds to that thought. The market's done so well for so long, it eventually has to turn around. And people were reminded 2018 of how dangerous this market can really be to their portfolio. So they're tempted to take some of that off the table, which, by the way, isn't necessarily a bad thing. It's just now when you take take it off the table, take some profits, what do you do with it? How do you construct it and put it in a place where it can still benefit you instead of losing to inflation and taxation? And that all goes into the portfolio, or the portfolio construction, which is based on your retirement plan.
So this is where we talk about low volatility investing and taking some of those profits off the table, like Lauren explained, putting them into an investment that cannot lose, that's guaranteed, so that when the next recession does hit, when the next bear market does hit, we can then take advantage of that piece that didn't lose like the market lost, and take pieces of that investment and reinvest it back into the at-risk, the S&P, while it's low, while it's down, so that you're buying low and ultimately then riding the market cycle back up. But in order to position yourself to do that, you have to not lose like the S&P loses. So that strategy is called dollar cost averaging. And in order to do that, you have to implement some low volatility investments and pieces into that portfolio to position yourself in a way that you can take advantage of those opportunities.
Now is the part of the show where we answer a question from you, the viewers. We have Carol in Altoona, and Carol wants to know, how do I know when it's time to sell an investment? We'll answer that question and much more when Retiring Today continues.
You have worked for a long time. There are so many decisions to make about your retirement. How much income do you need? How not to run out of money? Now is your chance, and you get one shot to get it right. Attend Merkle Retirement Planning's Passport to Retirement. We will discuss how to create tax-free income, how to avoid the next market meltdown, and how to wring every dime out of Social Security. Your time is now. Classes fill quickly. Call or text today. Zero cost to attend.
It's your retirement. How will you live it? How will you be remembered?
Will you be able to take me on vacation? Will you be there for my ball games? Will you teach me your values? You'll be able to play with me? Oh, help me go to college. How will I remember you?
Have the retirement you dream about. Contact us today.
Welcome back to Retiring Today. We are answering this question. Carol from Altoona asks, How do I know when it's time to sell an investment? I'm here with Lauren Merkle. He's a certified financial planner. He talks to families about this very thing every single day right here in the offices. And Lauren, what would you tell Carol?
I would say, Carol, that is an excellent question. In fact, we have this type of conversation with a lot of people who come to the class. We have this conversation with many of the families that we work with. What we need to do, what you need to do, is do the analysis on each piece of the investment plan that you have put in place. And even if you, and I'll give you some insight on what that analysis might look like, but even if you come to the conclusion that for whatever reason, right now, this investment is not a good investment for you, it's not a good investment for your investment plan, what we don't want to do is just start wholesale selling the investments underneath the portfolio. And the reason why is because what you want is you want a purpose for what is going to replace it. We don't want to just sell stuff to sell stuff without an idea or a plan of what is going to go in its place. And that's where the planning really comes into play, the investment plan of the retirement blueprint. Determine what your goals and objectives are, how your investments are going to play into accomplishing those goals and objectives, and then you can determine, does this specific investment work well for you to accomplish your goals? Does it not? Does this investment work well for you? Does it not? And if the answer to that is no, again, for whatever reason, then you can sell it, but we need to have a replacement in place to determine how are you going to accomplish those goals and objectives. So there's a lot of criteria that will go into, is this investment right for you? But first, we need to start with the plan. You need to start with the plan to construct, here's where you are, here's where you want to be, now specifically, what is it going to take to get there?
So today we've been talking about your retirement portfolio and the market, how those two work together to help you fulfill your retirement dreams. And now, Lauren, it's time for your list of takeaways.
Yeah, so list of takeaways. First of all, what we need to understand is that this market is going to continue to move. It's going to continue to go up. It's going to continue to go down. But what you want to do is make sure that your investment portfolio, the things that you can more control, go up and go down based on your risk tolerance, based on what it is your plan says that you need to accomplish from an overall risk perspective. The other thing is that you need to understand that the amount of risk in your portfolio should not be measured on a scale from 1 to 10, should not be measured with terms that are subjective like conservative, moderate, or aggressive, but we need to put a number around it. Meaning that if you have a $500,000 portfolio, and during this next recession, would your portfolio lose 100,000 of the 5? Would it lose 50,000? Would it lose 100? That's a better way to measure how much risk you're taking, because it's much more easily understandable how much risk you're taking. So if, Molly, you have a $500,000 portfolio and this recession comes into play and you lose $100,000, that's much easier to determine, am I comfortable with that? Am I not comfortable with that? Will that derail my retirement, or am I going to be okay through the ups and downs of the market? And then the final takeaway is we don't want to just start making investment decisions haphazardly without a well-constructed plan to guide us to what those decisions should be. So if we come across something in your portfolio that you're questioning, that you don't know if is right for you or not right for you, the plan will tell you, here's the types of investments you need to incorporate within your portfolio. Here's based on the amount of risk in your goals and objectives that you're trying to accomplish. And then once you have a well thought out plan of where you want to go, how you're going to get there, the pieces of the portfolio that you need to sell, want to sell, you can do that with confidence, knowing that there's a plan in place going forward.
Okay, you talked about it a couple of times throughout the show today, but the classes, you call them your passport to retirement classes. They're a great opportunity to talk about not only your portfolio and the market, but a lot of the other pieces of the retirement puzzle. Lauren, tell people about the Passport to Retirement classes.
The Passport class is a free class to attend. We don't charge anything to do it. It's just a great opportunity in a group setting to learn more about what it takes to successfully navigate through all the challenges that pre-retirees and retirees face. And we talk about how to deliver income. When you retire, you still need income. So how do you deliver income from all the different resources that you have in a meaningful way to you to make it last longer, ideally, than what we anticipate our longevity to be. When you take income, we're going to have to pay taxes on that income, but in retirement, you can more control the level of tax that you pay if the plan is constructed in a way where we have tax diversification. And we talk about that pretty in depth at class too, because when we talk about diversification, most people are thinking about the investment piece. Well, what asset classes are you invested in? What we're talking about in tax diversification is what types of monies do you have and how are they taxed? And how do you use that in a way to generate more spendable income and decrease the amount that you have to pay to Uncle Sam? The healthcare market is really daunting problem for many people because it's so expensive. And then you throw long-term care costs into it. It's a real challenge that needs to be baked into the overall plan. The legacy aspect of it, the investment piece, all of that stuff is what we talk about at the Passport class. We talk about it in depth. We have a lot of fun. It's interactive. And the main goal is to have you learn more about how to get to and through your retirement.
Okay, so if you're listening to the things that they're talking about at the Passport classes, here's what you need to know. You can sign up. It's a free class. There's a number on your screen. You could text Passport to the number on your screen. There's also a website on your screen. It's passportclass.com. You can go there. There's a lot of great information. Now, Lauren, the classes, most people come in, they really like them, but you do know that there's some people that a group setting could feel a little bit intimidating. There's an option for those people as well.
Intimidating, or some people just don't like the group setting, or some people it just doesn't fit well into their schedule, and that's fine. So if the group setting, the Passport class, isn't for you for whatever reason, then we also invite you just to come in and talk to us on a one-on-one basis. And if you want to engage in that type of visit, all you have to do, and make it real simple, text the word visit to the number on the screen, and then we can bypass the Passport class and just get down right to your situation and your concerns.
Okay, Lauren, so today we talked a lot about emotions, and I think that really how you measure sort of some of your success is when you sit down with a family and you take away a lot of the anxiety and give them peace going to and through retirement.
And that's the important part, is people want to avoid the what ifs. People want to have confidence that these decisions that they're making that are permanent decisions are the right decisions. So 5 years after retirement, they're not looking back and saying, what if? What if I would have made a different Social Security decision? What if I would have created some more of this tax diversification that we talk about all the time at the class? What if I would have constructed my income plan in a better way to make sure I don't run out of income prior to running out of time? That's what we're really trying to do. That's the power of the plan. It gives you the confidence and the emotional stability, if you will, to power to and through retirement.
And that is what it's all about. Lauren Merkle, thank you very much. And thank you for watching Retiring Today.
You have worked for a long time. There are so many decisions to make about your retirement. How much income do you need? How not to run out of money? Now is your chance, and you get one shot to get it right. Attend Merkle Retirement Planning's Passport to Retirement. We will discuss how to create tax-free income, how to avoid the next market meltdown, and how to wring every dime out of Social Security. Your time is now. Classes fill quickly. Call or text today. Zero cost to attend.
From our family to yours, we hope you have a wonderful weekend.
We hope you enjoy the show.
Dinner break.